Welcome to the CMB Brief, the podcast from Commercial Mortgages Broker. I'm Georgina, and this is our 2026 Commercial Mortgage Market Outlook, rates, products, and how a whole-of-market broker actually places a deal. Before we start, the important note. Commercial Mortgages Broker is a trading style of Lenzie Consulting. We are a broker, not a lender. Commercial mortgages for business purposes are generally not regulated by the Financial Conduct Authority, and where a case is regulated, we refer it to an appropriately authorised firm. Every figure you hear in this episode is an indicative market band for 2026, never an offer and never a quote. Let me set the scene. The Bank of England base rate stands at 3.75%, held at the June meeting after the cut from 4% in December 2025. Against that backdrop, commercial mortgage pricing has settled into bands that are wide but readable. Owner-occupiers borrowing to buy their own premises are seeing roughly 6 to 7.5% a year. Commercial investment mortgages, where the rent services the debt, sit at 6.5 to 8.5%. Semi-commercial and mixed-use property prices in the same range. A commercial remortgage runs 6 to 8%, and loans against trading businesses with thinner covenants stretch from 7 to 9. Short-term commercial bridging is its own world, typically quoted monthly at 0.7 to 0.95%. Hold those bands in mind because the whole episode hangs off one fact. The same deal can price a full point apart depending on which lender sees it. So why does one deal get two different prices? Because the commercial mortgage market is not one market, it is three tiers. The high street banks offer the sharpest pricing, but the narrowest appetite. Strong accounts, standard property, patient timescales. The challenger banks price a little wider and think harder about the story behind the numbers. And the specialist commercial lenders take the cases the first two will not. Unusual property, complex income, speed. A whole-of-market broker's job is to know, before an application goes anywhere, which tier and which lender inside that tier actually wants the deal in front of them. That is the difference between a decision in principle in around 48 hours and a month of dead ends. Now the products one by one. Start with the owner-occupier, the business buying the premises it trades from. This is the cheapest corner of commercial lending for a reason. The borrower and the tenant are the same covenant, and the lender can see the trading accounts. The affordability test here is the debt service coverage ratio. Lenders typically want the business's cash generation to cover the mortgage payments 1.25 to 1 2/3 times over. Get the accounts presented properly, and a rent-sized payment becomes a mortgage payment that builds equity instead. Commercial investment is the landlord's market. Here the rent does the work, and the test is the interest cover ratio. Rental income covering interest 1.25 to 2 times at a stressed rate, not the actual pay rate. Lease length, tenant quality, and the realism of the passing rent set the price as much as the loan to value does. In 2026, the appetite is there, but lenders are reading leases more carefully than they read yield headlines. Semi-commercial, the shop with the flats above, deserves its own minute. Valuers split the commercial and residential elements, and lenders weight the mix. The more residential the income, the closer the pricing leans to the investment bands, and the property often carries less voids risk than pure commercial. It is a genuinely useful middle ground, and it is routinely mispriced by borrowers who only ask one lender. Then sizing. Two numbers decide almost everything: loan to value and serviceability. Commercial lending tops out around 75% loan to value, so a deposit of 25% or more, in cash or in equity, is the entry ticket. But the loan to value ceiling is only the start. The serviceability test usually bites first. Terms run up to 25 years. Interest-only periods exist for the right cases. And the structure? Personal names, trading company, special purpose vehicle, even a pension scheme, changes both the tax picture and the lender list. Our calculator on the site runs the sizing arithmetic, and the criteria are set out lender tier by lender tier. Remortgaging is the quiet opportunity of 2026. Anyone who fixed at the top of the rate cycle or has drifted onto a lender's revert rate is a candidate. The arithmetic is simple. The saving across the remaining term versus the cost of moving, fees, valuation, legals. With base at 3.75 and the market expecting stability rather than cuts, waiting for a materially better market is a bet, not a plan. Capital raising against equity in a commercial property to fund growth or another purchase. Prices in the same 6 to 8% band. And when speed matters more than price, commercial bridging steps in. Auction purchases, time-critical acquisitions, property that needs work before a term lender will touch it. 0.7 to 0.95% a month buys certainty and weeks, not months completion. But the exit is everything. A bridging lender's first question is how the loan comes back. Usually a refinance onto exactly the commercial mortgages we have been talking about. So the exit is underwritten on day 1, not month 11. So what do we expect for the rest of 2026? Stability at the base rate, competition inside the bands rather than below them, lenders rewarding well-presented cases with sharper pricing, and the gap between the best and worst quote on the same deal staying wide enough to pay for good advice many times over. If you take one thing from this episode, take this. In commercial mortgages, the market does not give you a price. It gives you a range, and where you land in it is decided by preparation and placement. That is the commercial mortgage market in 2026. The full guides, the rate tables, the calculators and the lender panel are all at commercialmortgagesbroker.co.uk. Thanks for listening. I'm Georgina, and this has been the CMB Brief.